we did a space last week with Steve and AOP that you can see up here, as well as another great gentleman who was on that space as well, where we talked about, I mean, a couple of topics, but mostly money mentality and getting the mindset right and how to, make yourself, set yourself up for success. And wanted to kind of continue that today, but with just more personal finance tips, especially because we got Doug on this one that we do Wednesdays. We typically do something of Web3 and NFTs in this spot, but figured, hey, why don't we switch it up for a week, do something with personal finance. So, with that said, I would like to turn it over to Doug to start out with, which is, a lot of people are starting from ground zero with what their knowledge is of personal finance. And when people come to you, I'm curious, what are the most interesting topics to start off with? Like, what are some of the things people can establish from ground one that don't require them to have a bunch of money or access or anything like that, but just basic tips and advice? And we can kind of lead into the conversation from there. And we have three other great gentlemen on here as well that, you can utilize if you want to throw questions to them or anything. And I'll kind of run this one with you as a
Yeah,
co-host.
so good news, bad news. The good news is there's a lot you can do without having amassed any wealth or assets. Laying the foundation is something you can always start with, right? And it's also something you can always return to make sure you're getting all the more advanced stuff. You said, I don't know if it's the most interesting though. I don't know if cash management, which is that foundational piece, so two sides to that coin. The first side being cash flow, money in, money out, and getting really good and in control with how money comes into your life and how it goes out. So this is establishing a lifestyle for yourself that's comfortable, but also balancing that lifestyle with consistent savings and investment that get you to your goals. And not everyone can just dive right into significant savings or even get to investing. There's actually a lot of things to cover before you start putting risk on your money and consider investing, which is why we focus on this most foundational piece of cash management. And the bad news is, again, it's not the most entertaining or fun, investments and risk and making money and even losing money. It's certainly a lot more exciting and gets your heart running than thinking about, whether or not your budget is meeting the reality of how cash flow is actually operating in your life. So when anyone comes in the door to my firm, and when we put together financial plans, the first thing we focus on is that cash management piece. And it's easy to say, balance your lifestyle with consistent savings. It's easy to say that, but it's quite frankly one of the hardest things to do in all of personal finance is to get consistent and in a rhythm about, this is what I need to feel comfortable, or at least accommodate the type of savings I need to do consistently to get to my goals. So even before all of that, maybe understanding what it is that you want for yourself, right? And people think about their goals in very traditional, I know what the traditional ones are. I'd like to maybe retire, achieve financial independence someday, put kids to college, buy a home, start a business. But it's my clients' lives, it's your lives. You have to figure out what it is that you want for yourself. So you do these things, I think they go hand in hand, understanding what your goals are, and then being able to understand cash management around that. So again, a lot of boring work here. No one really wants to take their free time to go examine where their money's actually going. And here's the funny thing. People talk about, oh, you should have a budget. I agree, but the budget is what you think or what you hope you are going to be spending or, your money on or saving. It's cash flow, what you actually did, going back to reconcile the past behavior. That is what you're actually doing. And it's this notion of balancing or comparing your past behavior, cash flow, against your budget and being able to have the level of control to make adjustments and changes and tweaks, because it's a living, breathing exercise that you're going to be doing month in and month out. No one just does a budget and says, hey, I've arrived. So it takes a lot of practice. I'd prefer people not to game it, like literally live your life, see what you spend your money on. This takes 6, 12, maybe even more months to really build up the discipline and have the data, actually have the data of where stuff is going in order to feel confident around a budget that you're setting for yourself. And then the other side of the cash management coin is liquidity and having access to cash, commonly called your emergency fund, or your cash reserve. I like cash reserve because not everything's an emergency, right? And don't have to go with the negative connotation here. But rule of thumb would say 3 to 6 months of your living expenses in cash, right? So by doing cash flow and budget, you'll know what that's how you get that living expense figure, whether it's 3 grand, 5 or 10 or $20,000 a month to live your level of comfort in conjunction with what you need to be saving each month. We'll get to that in a moment. But liquidity and having access to cash is what helps you sleep well at night, knowing you can cover those emergency expenses or take advantage of an opportunity. That's where the positive spin comes in. Taking advantage of opportunities so you don't have to borrow or sell other assets to do either of those things, the emergency or opportunity side. And you can dial in up or down based on what's going on in your life, how you feel about the world around you and your health as to whether or not you want to take a strong or weaker or more, conservative or more aggressive stance, better way of putting it, with regards to how much cash you have, and also be cognizant of the environment you're in. Look, I got clients, you make a recommendation to hold 9 to 12 months of cash. That could be, $150,000, $200,000 in cash. Might not be the best look in an inflationary environment. They might need to retool that. But if your living expenses, are lower, and you're looking at reserves or reserves that are $25,000, $50,000, $75,000, might be worth holding on to that cash, despite the fact you're not getting anything for it, right? There's really no yield out there for risk-free investments. Just wait a little bit. Maybe we'll see rates go up. We probably will. Probably not to the tune of it being more attractive than maybe what you could get risk on. So that was a big chunk of info, but the most foundational component to all of personal finance, if you're looking to get yourself in control and organized, you gotta focus on this arguably very boring piece. But this is where all the good stuff is built upon. If you want to get to investing and tax planning and all the other areas that make up comprehensive planning or your personal financial life, this is where you start. And it's no joke. Those who take this area seriously and spend the time, those are the superstars. Those are the ones getting to their goals more effectively and efficiently than those who are just shooting from the hip and think they have an idea of where their money goes. Again, this is not to be, to put yourself in a position of being so methodical that you're, sucking fun out of like what you're doing here. This is simply a matter of being in control so you can make financial decisions that are the best for you.
Well put off the bat there by the man with the hair. Love to see it. Okay, I feel like we covered a bunch of stuff there. Cash flow, liquidity, a few other areas. Steve, I want to bounce right off of that to you. If you have any, thoughts first off on what Doug said, and then if you want to add on to this starting out topic here of personal finance and things people can do at the base, at the core, without having to, necessarily have a bunch of money, access, or knowledge.
Yeah, I would say that, I talked about this last time and Doug alluded to it pretty well, that when you earmark your money, I think it's going to be way, way easier to kind of wrap your head around, why you're saving. When there's a reason out there, you're saving for a particular like tangible, it could be a thing, it could be an event, maybe it's retirement, it could be funding your kid's education, it could be whatever it is that your future entails, whatever that looks like. If you understand why you're saving and you understand why you're investing, that is going to be the mindset that is going to enable you to actually do this day in and day out, month in and month out. Once you have that money earmarked, it's going to make it way, way easier because you have that light at the end of the tunnel. You're not just saving for no reason whatsoever. There is a reason, and you are actively contributing. You are taking steps to get there. I used to budget in a previous life, but man, I cheated that budget like nothing I've ever cheated before. Budgets are great if you can follow them, but man, I would always move money around between accounts just so I could spend more money. So budgets, I don't think, they're good if you're disciplined and you know what the budget is designed for and what you're saving money for, and you're disciplined enough not to cheat it. But I certainly was not that disciplined. I cheated it all the time. It actually enabled me to spend more money than I probably should have. So what I would say is, instead of budget, think of in terms of tracking your spending first. That would be the number one suggestion that I would give everybody. Because quite frankly, a lot of us, and me included in a previous life, we have no idea where the hell our money's going. Really, really, we don't. And until we understand that, until we get to that bottom line, like where is all this money going in terms of categories, like it might be food or gas or entertainment or concert tickets or whatever, we really have no way of controlling our spending and making smarter decisions with our money. That's a tough that is a really tough thing to do, especially if you haven't done it before, like going through your bank statements and credit cards. I mean, that's just not fun. It's not very enjoyable. It's not very sexy. But quite frankly, controlling your cash flow and figuring out where your money is going, that is just required training. You really do have to do it. And it's most difficult at the very beginning, but it really does. And trust me on this, it really does get easier the more you do it, but you just have to start. So I would say the big ones for me: earmark where your money is going so you have a purpose for saving, you have a purpose for investing. You're not just doing it for no reason. And two, track where your money is going, track your expenses so you know where to cut back, you know where to make smarter decisions so you can save more and you can start investing more.
I love all that. Steve's right on the money. Having goals or specific things earmarked to giving you the why. Why are you doing all of this, right? And he said something, Steve, you said something where like a goal isn't like I want to make sick bank, like not a goal, right? It's like when people say, hey, I want to say, I want $1 million. Awesome. Not a goal. By the way, if you said, I want $1 million in 5 years, that's actually a goal. So I wanted to bring up something, why you're doing it. Yeah, listen, I'd love to know why you're doing that, but you gave me an amount and a time parameter, which reminded me of a system that I used and created when it comes to goals. I saw that it wasn't good enough just to say what the goal was. You needed to identify what it is, but then you needed to quantify it. So as you think about what it is you want for yourself, tough question for a lot of people to actually think about what it is you want in your life. That can change, by the way. As you identify what those goals are, you then quantify them by those two components, time and value, like buying a home. You want to buy a home in the next 2 years. Okay, how much does that home cost? We need a number assigned to that. Let's say it's a $500,000 home. Rock on. We can now do some basic math to understand what we would need to save each month in order to make that happen. Harder when you say, I want to be financially independent by 55. We use, retirement tools and complex financial calculators and financial planning software to run these simulations. But nonetheless, we need to know when and what kind of lifestyle. And you can do this for every single goal you've identified. You can quantify it by time and value. And then the third thing you need to do is prioritize. Look, if money wasn't an option, you could crush all your goals right now. Go get the villa in Milan, go get that yacht, do all those things. But look, money is an option for the vast majority of us. And there's only going to be so much free cash after you figure out what your lifestyle is, figure out what you need to be comfortable. I'm putting air quotes around that because that's subjective to everyone. You need to be able to prioritize your goals so or have an accounting of the first and last dollar of available savings. You might find out that you can't max out your 401k plan and put $1,500 away each month for that home goal you have in 4 years. There's just not enough cash. You either got to go make more money or get more uncomfortable with what you're spending on your lifestyle. So that prioritization part is super important because it sets the expectation and will potentially help you shuffle around which goals subjective to you are the most important. I remember that my wife and I had no ability to accelerate paying down our student loan debt when we knew we wanted to go buy a house because we were having a kid and needed to get out of the city. It's okay for the goal priority move around, but it was very helpful for us to realize, okay, our free cash is now going to go to cash for that down payment as opposed to an extra buck or 100 or however much money towards a loan or into our 401k. Look, sacrifices need to be made, but when you make those sacrifices, you know exactly what it's affecting in terms of the things that you want. So a cool little system for anyone listening: identify, quantify, prioritize. This is a great way to get your arms around your goals as opposed to just saying, I want to buy a house. Great goal. How are we going to go about doing that? And where does this fit into all the other things that you want to do? So Steve's spot on. Have something to save towards, but have a system in place when it comes to those savings.
Awesome. Love it. AOP, let's get you involved in this. You want to bounce off the other guys and add to that?
Yeah, I mean, I think it's absolutely essential I want to talk about a little bit what Doug said, by the way. I think Doug is one of the best tweeters out there. I just want to add this in. I don't know how much I'm going to be able to get to talk today, but I wanted to add in that Doug is just absolutely one of the best tweeters out there. I say this as somebody who's sold well over 1,000 content creation guides on how to use Twitter.
Thanks, man.
Doug is just absolutely A+ game on Twitter, and I just want to give him a shout out. So I want to talk about money and how to think about things from everything from your purpose in life. Like, if you're married, have you sat down with your partner and have you discussed all of the things that your dreams, your hopes, and your desires? Have you, even if you're single and you're by yourself, you're rolling solo, have you thought about all of the things that you really want in life? Are you chasing things that are just materialistic goods that you've been watching TV, you watch advertising, and you're just caring about only the fads and the trends and what society has defined for you that's important, like that flashy, shiny car? Or are you making decisions based on what you truly want and desire? Have you actually sat down and written those things out and try to identify what your purpose is in life? What do you want to become? What do you really want to be? So one of the most powerful things that I did, I actually think personal finance is a way to personal mastery. I think budgeting is boring and those kinds of things. Yeah. But becoming a better person is exciting. So when you look at life like this, I actually sat down one day and decided I was going to become wealthy. I know that sounds nuts, but I literally woke up and was like, I'm going to become wealthy. I wrote it down. And then another time, as my dreams and desires evolved, I said, I'm going to become so wealthy and I'm going to develop a online business, and I'm going to walk away from my 9-to-5 job. I literally wrote this down, and kind of gives you a real deeper connection for what you want to do. So you'll start to see things. The benefit to doing this is that you're going to start seeing things through everything from this prism, right? So once you actually identify what you truly want, when you see the flashy ads and when you see the flashy stuff and you see people rocking Rolexes, nothing wrong with that. I get it, right? If you're using those things as a tool. But if it's not really fulfilling you in a deeper fashion, you're just going to be chasing the next shiny thing. Instead, view everything from what you want from your life mission, from your life purpose. And then at that point, everything else becomes a diversion, and aim for excellence in yourself. So think of budgeting and maybe not think of budgeting, but think of getting control of your personal finances as a way to develop yourself.
I love that.
How much of it, Doug, do you find with your clients is mindset?
A lot of it, a lot of it. And it's, not to sound, blasé, but, you see clients who come in the door and, you see it in their eyes. You see their desire to get the things that they want for themselves. And it's backed up by their actions and their ability to take the recommendations that are provided to them and implement, right? So after we kick off relationships at the firm by doing planning. We don't even touch investing, and that's even optional. We might not even do investing for that client. We're interested in doing the planning and getting their financial life together on a number of topics, from cash management through estate planning. So you can see who, after you do the plan delivery and we provide a summary of all the action items from our recommendations that need to take place, You see clients who get it done within weeks of delivering that plan, and then you see clients who, take more time. And there's nothing wrong with taking more time. I mean, I got clients who got 2, 3 kids running around, 80-hour-a-week jobs. It's simply a function of how much free time they have to get these things done. But even you could look at those, even though I'm giving them an excuse here, the folks that really, really want, and I say that directly to clients, and it's not even a function of how much, you would think the folks that making a lot of money and have the capacity to save consistently would have an easier time with it. And that's just not the case. It's true, it's not a function of how much you make or how much you have to the art of purpose's point here. It comes from within. And by the way, this is no different. The same is true for money and your finances and your health when it comes to exercise. To quote, my good buddy Morgan Housel, you might not care about, personal finance, health, or diet or exercise, but they sure care about you. I butchered his quote, but you get the point here. These all get filed under, self-improvement and self-care. They really, really do. So if you really, you're not going to be able to do much unless you want it for yourself. So knowing what the goals are, and to AP's purpose here, point here, when you find fulfillment or figure out what it is that makes you feel happy and, humbled in what you're doing, you're on the right track. But it is insanely difficult today, more than ever before, with the distractions that we have from social media to what we see. People are filtering their lives through the lens of Instagram to make it seem like you should be doing X, Y, and Z instead of focusing on what you really, really want here. It takes a lot of maturity, it takes a lot of introspection and a lot of self-awareness to really do that to a very high degree. And this is why, again, now folding it back into the foundational areas, you might say, cool, cash management, budget, cash flow, having the right amount of cash, is really boring stuff. Take me over to the action. That's where you're going to go wrong. That's where you're going to screw it all up. You would never build a house on shaky ground. Otherwise, a gust of wind is going to come blow that structure down, right? You want to build that really nice house, this financial life, these goals on as sturdy of a foundation as possible. That's why we spend so much time talking about these almost mundane things. Guys, they're the most important part of all of it. And it does help develop your purpose and what fulfills you as you think about what your financial goals are.
Love it. I'd love to pull in here, first off, stock market news. Want to get you in this if you have a second from building and you want to add to the convo. And then there's another topic which I want to hit on, which I think is going to deliver a lot of value to the audience. But stock market news, anything you want to add in right now?
Sorry if the quality is bad. I'm having trouble finding my headphones, but only thing that I really want to add in with the personal finance, it has been touched upon a little bit, but I do want to echo it. There's a lot of really important steps in here, but the buck stops. There's no way you can do anything if you don't know where you're at. You have to be tracking your expenses. You have to be tracking your finances to then kind of go in and see where you're at and make changes. So for anyone out there, I think that's, a very, very important first step out there. Maybe it's not the first step. Maybe you want to go in and determine your goals and what you're going for, but understanding where you're at, how you're spending your money, what's coming in, what your expenses are like, is up there on the one of the first things you should be doing in this area. So just stressing on that. Big shout out to all the other speakers up here. Fantastic accounts, very knowledgeable people, some funny tweets from their pages as well. So check them out, give them a follow, and big shout out to Wolf for putting on the space. I'm happy I could be here and a part of it and learning some great lessons.
Awesome. All right, so I want to dive into something here, which maybe it's putting my speakers a little bit on the spot, but basically, I want to hear something that is in relation to personal finance, where when someone taught it to you for the first time, you kind of went like, oh, that's going to change the way I do something here, and it's going to make a big long-term impact on, my personal finance. So, for example, here, when I really learned about the ways to establish and build my credit, one of the ways was where someone told me, hey, every 16 months, you have to use that credit card. Doesn't matter if it's $1 or $2 purchase, it's going to keep it open. And as you continue to open new credit cards, you're going to expand the amount of your line of credit, meaning that even though you may be using the same amount each month, it's now a smaller percentage of your total credit. That's another way to build it. Number 3, they showed me obviously, having them longer and staying open longer, it provides a longer timeline and a longer average opening. Basically, like, I didn't know all these things. I didn't know that my credit card was going to automatically close out after 16 months if I didn't use it. I didn't know, like, or realize, hey, as I stack these credit cards and open up more, there's a benefit of I'm using a smaller percentage of my credit line. I didn't know, that they add up and now longer time horizon. And I think, there's probably people in this crowd who are maybe even 16, 17, 18 that are probably learning these things for the first time. So, Doug, I'll kick it to you first. Is there something in the world of personal finance, whether it's credit or budgeting or investing or anything like that, or maybe it's a stat, and you learned and you're like, oh, that changes how I go about this?
That's a really good question. I liked what you had to say about credit. I always feel like the rules and tricks behind, the credit scoring system and building credit is a shadowy and opaque kind of thing. But a lot of things that you brought up are true. It's all about consistency. It's all about utility ratios and things that you can read up on that show you're a good borrower. And one of the things I had learned was just getting as early of a start as humanly possible when it comes to building that credit. I was fortunate enough to I think I was in college. They were opening like Blue for Students Amex cards at the hub or the Union. And I got like a $600 line of credit, on that card. And every semester I would go online and double it. So I think by the time I had graduated, I had like a solid $25,000 line of credit with American Express, my own social, my own, it was designed for that very purpose. And I just took, and that would go on and help me do a lot of things here later in life, whether it was buying cars, leasing cars, applying for credit for business and personal uses, even more on the business side of things. During the Great Recession in 2009, there was a financial advisor needing to get rid of some clients, excuse me, this sounds terrible, wanted to no longer service clients and needed to find an advisor that was willing to take on those clients. And, I needed cash in order to quote unquote, facilitate that transaction. I was able to, go to Citi and say, hey, I need, $10,000. They gave me 0%. This is the height of the recession, giving a 24-year-old 10 grand at 0% for 18 months. I was like, oh my God, I'm going to make a cash flow positive transaction right here on day one. So thanks, Citi. But more importantly, thanks for having good credit, going into my young adult life and into my career. And then later on, of course, whether it's getting a mortgage for your home. So we know these are the things that we can use it for. Debt and credit is a very important tool to have in your life. It definitely greases the economic wheel, not just of corporations, but of your own household. So credit's super important. I'm glad you brought that one up. Is there anything else that I said, oh, so that's how that works? I think when we get into investing, maybe I'll want to double down on the importance of creating systematic building, systematic mechanisms. I'm failing to find the word I want, but whether it's saving or investing, getting things in a way that happen automatically is going to be one of the most important things that you can do. I find people like to fight, their human urge to either time things or wait for a better time to do something. Even right now, a client emailed me saying, hey, with all that's going on with Russia, should we pause or change our dollar cost average arrangement? There you see the instinct, the human behavior to want to, fuck with something, when in reality, what you have to do is stick to that plan. The very reason you're doing these things is to account for the fact that markets can get wild, things can get weird, and this is where you're going to be able to buy those discounts without having to think about it. So we'll get to that hopefully when we talk about investments later on here. And I want to talk a little bit about just even earning the right to invest. Like, when is it really the appropriate time? So there's one thing, and I'll pass it over to Steve or back to you, is this concept of earning the right to invest. It is a criteria or a number of things that need to be met before I thought you were in the proper position to be putting risk on your money. So it goes back to the system for goals, the identification quantification and prioritization of those goals. It goes back to mastering cash flow, being in full control of how money comes in and out of your life. And then it goes into meeting your short-term cash related goals. I tend to think that anything that's 4 years or less in terms of a time horizon, I have a very low, if zero, appetite for risk. I rather know that that money is there for me than even risk a penny of it going down because I took risk on that money. So if you're going to buy a home in the next 2 years or need to buy a car or whatever it is, pretty much saving to cash. As much as it pains me to get, negative real rates or 0% or less, less meaning the real rates when you factor in inflation, you're going to, what's going to hurt me more is, if I put all that money in the S&P 500 and it dumps 20%, 2 months before I need to use that cash to go buy that home or car or whatever it is I'm looking for. That's, to me, a lot more painful than missed out on a 10% gain over that period of time. So once you satisfy all cash needed goals, building up your cash reserve, saving the cash you need to execute on those short-term goals, you do all the things that I've just mentioned, you are in the perfect position to start putting risk on your money and start to invest your money. And we can get into how to go about doing that. But this flies, I want to mention this, guys, this flies in the face of a lot of things you've been told, right? That the sooner you invest your money, the more you'll be able to compound. Well, guys, your ability to compound your wealth through investment is only as good as your ability to stay invested. And you're going to have a hard time staying invested if you didn't build the foundation that allows you to do that in the first place. This is why I take somewhat of an issue with folks who just want to, from the jump, get as much money into the markets as possible. All right, there are exceptions to that. Matching contributions to your 401k, aka free money, or you're so young that you just, you're not at a spot in your life where there's enough responsibilities and, there's no better place to put it than maybe taking those risks, sure. But outside of those things, getting to that point of being comfortable and confident in investing, that's a big deal. So again, system for your goals, mastering cash flow, handling your emergency fund and short-term cash flow, and then being in a position to, what I was saying was flying in the face of this conventional wisdom that's been shared with you and shared from, I guess, older generations down to us. Hey, son or daughter, I hope you're getting money into your retirement plan. It's like, I'm trying to get all this foundational stuff done first so I can feel good about putting that money into a retirement plan or taking risk on that. It goes against the grain of that. But I think long term, when you do have time on your side and you're particularly younger, this format, this way to go, produces better long-term gains than just saying, fuck it, I'm going to, throw as much money in the market as humanly possible. Great. 2 years goes down. You have a different, you now need 50 grand to do something. Now you're selling $50,000 of your investments at a time that maybe sucks, maybe you're in a recession. Can you imagine needing that money and it's, April 2009? Like you just had a 45% drawdown, 50% drawdown. Like you definitely screwed up. You definitely didn't go about that the right way. So I hope that makes sense for you guys in terms of, when to get to, so you're saying, how that works. When do I know it's the time to be investing my money?
Love it, Doug. Well put, well said. I really enjoyed that, Steve. I'd like to ask the same question to you as to what you learned that really, when you learned it about personal finance that stood out and was like, I'm going to make a change. I'm going to do something different here.
Boy, there's a couple of things I could talk about, but one is the most important one. I've always wondered how people do this, like how they're so almost robotic or systematic about their investments. How do they keep doing it? How do they keep saving and contributing to their investment portfolio? Do they mark something on their calendar and sit down and do it? Or how does all that happen? And a few years ago, well, it's probably 15 or so years ago now, I finally discovered what the secret was. And quite frankly, it's not a secret at all. It is automation. Once you figure out how automation can work for you in your life and saving your emergency fund, investing into whatever you happen to be investing in. Once you figure out automation, once you understand the power of what just letting the system do the work for you, it becomes unbelievably easy to save, unbelievably easy to invest. It is literally no work after you initially set up your system. If you work a full-time job, you probably have access to a 401k or a Roth IRA or maybe an HSA or whatever. Those things can be funded generally through the power of automation and letting your organization, your employer, just take money out of your paycheck and contribute it to your investments. You set it up once and you literally don't have to lift a finger again. But even investments outside your 9 to 5 job, even if it's like a brokerage account or real estate investing or whatever, you can often at least set up like automatic bank transfers. So you transfer maybe $500 a month if you're building an emergency fund in the separate savings account, for instance. You just set up an automated transfer and you just get that done. You can do that with some of your bills too. The bills that are repeatable, that never really change, like your rent, maybe your cable television, whatever. I mean, if the more that you can take out of your hands, the easier it's going to be to build wealth. The easier it's going to be to not forget to do the things during the month that you should be doing. That's going to actively contribute to your future self, actively contribute to your wealth in the future. So to me, that is the key to long-term wealth. The absolute key is to set it up once and literally forget about it. With one little caveat, you can't completely forget about it. If things aren't working, if you're investing in the wrong things, you have to rebalance, things like that. I mean, it's not something that you just never look at again. You're gonna make tweaks here and there. You are gonna make it better as time goes on, right? You're not just gonna set it up and just pretend that everything is working. I mean, do your due diligence here. Pay attention. Make sure that things are actually working the way that you intended. But really do use the power of systems. Use the power of automation. Set these things up and just let them run. Therefore, you don't have to use your discipline. You don't have to remember. It just happens.
Yeah, I'm going to double, triple down on what Steve's saying here. The automation process is so paramount to getting good at this. It's that absolute essential layer that gets applied to all the work that you're doing here in the beginning. There's a learning curve. There's a lot of work and time and effort that goes into getting in the position to begin automating and feeling confident about what you've systematized. By the way, it also allows you to do some pretty interesting things. Look, my clients often are very busy, and it might be an unreasonable expectation that I, when asking to go look back over 6 to 12 months of their living expenses to see where their money's going, to be met with, are you out of your mind? I'm not going to be spending my free time combing through expenses. I can even point them to, financial technology tools, whether it's, Mint or Tiller or whoever is your favorite app to use. Automation cuts through a lot of this, where if you want to figure out how much you're able to save above and beyond, in addition to what you're automatically contributing to retirement plans, your 401ks and things like that, set up that reoccurring amount, whether it's $500 a month, whatever the amount is, from your checking to your savings or checking to your investment account. See if you can do that for maybe up to 3 months consistently without having to dip back into your savings, and then say, I've been moving $500 from my checking account to my brokerage account every month for the last 3 months, and I still see cash accumulating in my checking account. Or, I don't know if I'm accumulating or losing cash in my checking account, but I haven't had the need to go reach back into that brokerage account or that savings account to go pay a bill. That's how I call this is the acid test approach. That's how over that 3-month period of time, you were consistent at saving that amount, plus whatever maybe is going in your 401k. You have a floor now established for what your savings rate is. So guess what you do? You push the envelope. You try and ratchet that amount up from that 500 to 750. See if you can get that under your belt. over the next 3 months. You got a raise? Fantastic. Push it higher. The goal here is to constantly be attempting to ratchet up that savings amount by also keeping in mind that, look, you worked hard, your income's going up, you're succeeding professionally, and it's being shown in form of compensation. Yeah, maybe you want to increase lifestyle a little bit too, because you deserved it. What's that extra vacation or, a little bit nicer of X, mean? Can you balance that against your ability to ratchet up the amount that you're saving and investing month to month? So Steve, he's spot on. He's spot on with saying, look, there's so much power into automating all of these things. I wanted to dive just a little bit deeper into what you can learn from automation. Set it and forget it in a lot of places. Absolutely. Steve's right. Think of it like this. You're building a machine. You're building a machine that does require some upkeep. You want it to be able to run without you messing with it. You're getting the gears in place and building this thing up so you can run it. And then once it's running and you see that things are working well, you're always going to want to come back and service that thing. Maybe there's some parts to upgrade. Maybe you can get better efficiencies out of it, meaning more savings or investing each month. Maybe there's more new tools or different types of investment or savings vehicles to put in. Those are the gears. So, that's one way I explain it to my clients is we're trying to build this machine that can operate fluidly without, is that a word? Without you needing to necessarily be fixing it or messing with it, other than the exception of upgrading it and getting more money saved or invested. So that's the power of automation beyond just knowing that something's working for you. It is in of itself a tool that you can use to shortcut a lot of the manual labor that I asked you to do or think about doing when it comes to getting in control. By the way, nothing wrong with taking the time to get down to the nitty-gritty details of where your money's going. And I say that because people with tighter budgets or lower income levels, it's going to matter that much more to get it right because their margin of error and room for additional savings and spending is traditionally much more narrow than those who are higher earners, where, look, there's obviously a lot more ability to toggle between lifestyle and saving. So, choose which path is right for you. They're not mutually exclusive of one another, but automation all the way.
Yeah, it's a super interesting path there, and I have a lot of friends that have that set up. One of my close friends, Colin, decade investor here on Twitter, I kind of asked him, I was like, he's the same age as me, maybe a little bit older, and he's got net worth around 160K right now. And I was like, what was your trick? And he said, I started investing at 17 and, started creating income around the same time. And he said, I invested every single week the same amount. Didn't matter what market conditions were. I have it auto set up and it's been going for years. And now he, rode this bull market up. And if he had been like waiting, opportunity here, well, I'm going to wait for the dip, I'm going to wait for that. But it missed so much opportunity, but instead has just continued to accumulate and put more and more in, and now has a nest egg where you can use that to branch out into other opportunities and perhaps take on some more risk and things because he spent that time. So I think for everyone in the audience that's hearing this, even if you just start, putting in $25 to $50 a week, a month, whatever you can do to start out with, after a couple of years, you're going to be able to expand into other areas. So really, really good lessons there. AOP, want to drop it off to you. If you want to bounce off of that stuff, that's fine. And then also if you want to give us kind of the thing that stood out to you in the world of finance. Yeah.
I don't want to sit here and keep repeating the same things that have been said. So let me go off in another direction because I don't want to bore people.
Let's do it.
All right. So you were asking, I'm trying to remember back when you asked the question. So the question I think that you asked like 30 minutes ago was, what is the most important thing that you can do if you're trying to get your personal finance together? Well, if you are, I'm just going to say it straight, it's learning how taxes work in the United States. So if you're in the United States, a cold hard fact is that the tax system rewards smart people, intelligent people. It's designed in a way to take away money from people who work 9 to 5s and spend a lot of money. Right? The IRS loves those people. But for the people who are intelligent, have a high IQ, and have enough discipline to educate themselves for how taxes work, their pathway to wealth is much quicker. And I highly suggest you not hiring a financial advisor. Do not hire a financial advisor. Learn it on your own. Internalize the ideas. If you want to later on and you want to send some of the money to them, later on you can. But you're much more powerful when you actually internalize and learn these concepts for yourself, if you're in the United States. So if you're not in the United States and you're listening, the biggest personal finance tip that I can give you from a mental perspective is to think of yourself as a CEO with everything that you do. Crown yourself CEO. I actually got this idea from a Jesse Livermore book. It's kind of hard to believe, but think of your running your finances like you're running a Fortune 500 company. All right, take that much, put yourself right in that perspective. Every dollar that you have is a soldier. Every single thing needs to have everything needs to have a purpose. Think of your dollars maybe even like they're employees, and you're going to put them to work for you. You're going to try to save them. You're going to try to think about increasing your cash flow by trying to any way possible. Options, overtimes, raises, get a second job, do what you need to do to increase that cash flow. And then you'll be looking at everything from a relentlessly cut expenses away. Think about what you can control. Expenses are great because those are expenses. You can pretty much primarily control all of your expenses. So they're automatic wins for you. So you're either looking at it from a increase or decrease perspective. But think of yourself as a CEO. Take that much responsibility when you put together your personal finances. And then all of the decisions that you're going to make from there are going to be so much easier. All right. Hey, I got to run, but if you want to learn more about how to increase your finances using Twitter as a way to make money online, click on my profile picture and read my pinned tweet. I had to get running, man. Wolf, I actually have to go look at microwaves, because mine just died this morning. And if you know anything about I don't even want to get into this right now. But y'all have a great and fantastic day, guys. Thanks for having me on.
Love it. Thanks for being on, AOP. Always great having you, and we'll get you on another soon. I will say I do not know a ton about microwaves. The microwave that I currently use, I think I found in the hallway of a freshman dorm like 5 years ago, and have just kind of taken it with me since, and still working. So it's doing good. That's saving, right, Doug?
Yeah, speaking of microwaves, like I think 1 or 2 weeks, like literally into lockdown in 2020, from the pandemic, our microwave broke, which is probably the last thing in the world you want to have happen as, you're figuring out where you're going to get food from and all this stuff. And it's a sits above the range, like mounted into the wall. And it was, my wife in a sheer panic, like, wow.
No, Doug, that is what happened to me this morning. And you have to buy, you have to buy the exact same size.
Yes. Yeah. So I called the Top Line Appliance, local appliance place here, and I literally bought the same exact microwave, which was extraordinarily important because there's bolts and alignment that, you gotta, I was in no position to have someone come do this. I'm luckily pretty handy. There's videos of this. There was by far the most challenging install. The thing weighs, easily 40 pounds, and I'm trying to get these massive bolts secured. You got to open the thing up and know which way the ventilation's blowing out. I think I got that part right, not sure. Dude, it was insanity. All I remember is that I looked outside our back door and there was the exact same microwave the appliance place like dropped off. Nobody knew what to do in terms of like procedures other than just like stay the fuck away from each other. There's a pandemic. And I just remember my wife trolling me and taking videos while I have like a 50-pound microwave balanced on my right shoulder on like making sure it just doesn't fall, 8, I'm staring at the microwave right now, 8 feet, damn you, microwave, to the ground. Success though, success. One of my more successful installs. Good luck on the microwave part. Not sure about this. Don't hire a financial advisor. Speak. No. Actually, I agree with a lot of the things that you just said right there. There's, the point is there's so much stuff that you have to take in control yourself before you could really leverage, a lot of financial professionals. Then I totally agree with you there. There is a lot you should do and know about before you just farm it out.
Love it. Want to come in here real quick and just echo, everything that's been said, but then also just state that these are fantastic people to be following if you want to have more of this type of content in your Twitter life in general. Obviously, Doug has his whole entire firm. Steve, his newsletters, his programs, everything. AOP talked about his courses. Really, really good stuff. But they also put a ton of content on here. They obviously all have large followings. Multiple are verified. I recommend clicking in and following them since you're already in here. these are just some of the top accounts on FinTwit for content that you're going to find, and they really extend outside of FinTwit as well into more personal finance and other areas. And then of course, Stock Market News and myself. If you enjoy Spaces, we do about 19-20 a week, dozens of hours and tons of content. In fact, today alone we have multiple other trading spaces, investing spaces, NFT stuff, and more. So definitely be sure to check that out. Stock Market News. I saw you unmuted there. Did you have a comment?
Yeah, just honestly on the microwave topic, it got me really engaged there. I love this whole Spaces so far, but I just want to throw out there, I will take a toaster oven over a microwave any day of the week. You could take my microwave away from me, give me a toaster oven, and I'm happy for the rest of my life. But that's all I wanted to get in there. I know it wasn't fully, but yeah.
No, I'll keep going with the microwave speed. I actually agree that, toasters or toaster ovens in general, as far as, but microwaves for the lazy is what you're saying. You need, you want it hot and soggy, you got it, microwave all the way. But I don't know, there's the instant, there you go, instant. Right, look it up, microwaves. I just wanted to say, shout out to toaster ovens.
Shout out to the toaster ovens.
All right. So I do want to dig a little bit more into the tax stuff in a second, but we also got Jack Rains, who came up here, who writes a great, it's his own newsletter, Young Money, with Jack Rains. And he puts out really interesting articles, kind of taking real life experiences and then bring them over into the finance world. And maybe we'll bring up a question or two from the crowd as well afterwards. But Jack, do you want to insert anything into this conversation?
Yeah, I'm actually sitting in a cafe right now and just saw this, so I wanted to jump in. So any apologies for any background noise. And Doug, I love your memes, by the way, best memes on FinTwit. But anyway, something that I thought about, so for perspective, I'm 24 years old, single, pretty young, and I think that's something that people miss a lot of times in the whole personal finance thing is risk tolerance, not just in investing in equities versus fixed income, but risk tolerance in what they want to do with their careers. And it's something that I heard from my dad, my grandparents a few years ago that kind of stuck with me. But if you're younger, right out of school, and you don't have any major debt and no real obligations like a mortgage, you're not married, it's really the best time to kind of swing for the fences. If you want to do anything in your career that's just spontaneous, outrageous, weird, if you want to go move somewhere different, go with a startup, because your time horizon is so much longer before you need your retirement money, in your early to mid 20s, that's really the best time to shoot for those high risk, high reward things. Like Wolf said, I'm writing a finance blog. I work for a finance meme page, Liquidity, right now. And I'm just trying to produce content on the internet and travel a lot. And if it burns out, I've got plenty of time to get another finance job like I used to have. But I'd imagine there's a lot of people in here that are kind of like me in that same age group. And it's easy to get in the mind space that, you can't take a risk yet, but maybe after you work a few more years, you'll have more money saved up. And while you do need a safety net of capital, when you don't have those big expenses and when you're younger and don't really have a family, it's much easier to take those shots. So that's all I had.
Yeah, I really like that. And I struggle, believe it or not, a demographic I actually struggle to give really solid advice to sometimes is the youngest of the, millennials or even your older Gen Z, where there's just not a lot. I'm 37. I'm a geriatric millennial. I've grown into my typical client, settling down, having kids, and a lot of things to juggle on the responsibility and financial responsibility side. And then I'm faced with folks who, hey, I just, I'm 23 and my company went public and I'm now holding on to $800,000 worth of RSUs and options. What should I do? And it's hard for me to be like, yo, your job right now, your roles in life are don't die, pay your bills, and don't get fired from your job. That's a luxury. It truly is. If those are your biggest concerns in the world, I'm trying to be funny and oversimplify things here a little bit. But for that, maybe for that individual, perhaps the idea here is to get that head start, that leg up on getting money to work. And I know that's now contradictory to, I also don't think it's in replacement of the foundational and fundamental stuff. I think that's going to be easier probably to crush I also think it's going to be harder for that younger person to know what they really want, because I think understanding what you really want comes with a lot of life experience and going through some shit. So yeah, maybe for them, the easiest thing and maybe even the best thing to do is to start getting that money to work for them. I was out to dinner with my associate last night, Cliff, guy's 22, picked him up in the middle of COVID, in the middle of pandemic. And I asked him, I went to our offices downtown in Manhattan in Financial District. We're out to a nice dinner because we hardly come in anymore. And I said, so when are you coming to New York City? I live in the burbs of New Jersey. I don't even live in the city anymore. And I was just like, what's your plan for this almost quintessential first year in New York City, paying absurd rent to be in the action? And he turns to me and says, it's like, you know what? I don't even know if I'm going to do that. Me and my buddy much rather take all that rent money and all that bottle service and having fun on the weekends and put that into our first property. And I'm just blown away. I'm like, oh my God, I can't imagine saying something like that when I was 22 or 24. I definitely went up to New York and did the whole, New York City experience and had a ton of fun, and God knows how much money went into having that type of fun and doing those types of things. So maybe it's a product of how the world has changed from pandemic's point of view. Maybe we're getting the importance of personal finance drilled into the youngest generation, capable of actually earning money and putting it away. I'm not 100% sure if it's one. It's probably a lot of those things. But God, I gotta tell you how awesome it is to hear like young 20-something-year-olds are like, hey, I'm gonna delay some gratification here, and instead focus on securing my future.